Hello everyone, we completed directive number 2 and now let's move to directive number 3, which is regarding provisions relating to single obligor and limitation of the sectoral credit and facilities. The very first point under this is single borrower credit limit. The specified maximum limit of credit that any licensed institution can provide to an individual customer, firm, company, or a group of interconnected customers is referred to as the single obligor limit or single borrower credit limit. Next provision is fixation of limit on credit and facilities. So, a licensed institution can maintain and provide a single borrower credit limit up to a maximum of 25% of its core capital for a single customer, firm, company, or a group of interrelated clients, including both fund-based loan and non-fund-based facilities. In light of the country's production, employment, and other aspects, a maximum single borrower loan limit of 30% has been set for the export sector, small and medium enterprises, transportation infrastructure projects, pharmaceutical manufacturing, agriculture, tourism industry, cement industry, iron industry, and other production oriented industries. When approving the limit for such loans and facilities, the limit for borrower loans and facilities must be determined based on the primary capital shown in the balance sheet of the licensed institution, verified by the internal auditor for the preceding quarter. Similarly, in cases where there are industries or businesses within a customer group that require both type of limits as mentioned above, the loan exposure and facilities for such a customer group should be maintained at a limit of 30%. However, under such total loan exposure and facilities, the limit for loan exposure and facilities except for those industries specified above that require a 30% loan limit should not exceed 25%. Number 3, regarding the provision of loans for hydroelectric and other renewable energy projects, power transmission lines, and cable car construction projects. A licensed institution can provide fund-based loans and non-fund-based facilities up to 50% of their primary capital for hydropower and other renewable energy projects, electricity transmission lines, and cable car construction projects. However, in the case of hydropower and other renewable energy projects, if more than 25% of the primary capital needs to be provided as a loan, it is mandatory to have a power purchase agreement with the concerned authority. When preparing the repayment schedule for such projects, it must be done based on cash flow and other verified evidence. Similarly, the installment payments can commence after the later of the moratorium period determined by the relevant bank and financial institution, or 3 months from when the electricity generated from the project is connected to the transmission line. Licensed banks and financial institutions are allowed to increase the single borrower credit limit from the existing 25% to up to 50% of the total primary capital when investing in pure hydroelectric projects, electrical transmission lines, renewable energy projects, and cable car construction projects. However, if customers of hydroelectric projects, electrical transmission lines, renewable energy projects, or cable car construction projects wish to invest in non-hydroelectric electrical transmission line, cable car loans or facilities, can only be provided up to 25%, including fund-based loan and non-fund-based facilities, without exceeding the 50% limit. Similarly, if for any reason the credit flow exceeds the specified limit in non-hydro, electric transmission, cable or renewable energy projects, a 100% loan loss provision must be maintained for the amount exceeding the limit. Next provision is single obligor limit of margin nature share pledge loan. The maximum single obligor limit for loans of a margin nature disbursed through share pledges from one or all licensed institution is set at a total of Nepalese rupees 150 million or 15 crore. However, this limit will not apply to only to institutional investors established with the main objective of investing in the securities market. Banks and financial institutions offering or renewing such loans must ensure that the limit is not exceeded during disbursement or renewal. If a loan is disbursed or renewed beyond the specified limit, the bank or financial institution must maintain a 100% loan loss provision for that loan. The next provision is exemption in limit of credit and facilities. So, in the case of the following loans or facilities, the single obligor limit will not apply. The very first one is term deposits, Nepal government securities, Nepal Rashtra Bank bonds as collateral, and loans, borrowings and facilities provided under the unconditional guarantees of international multilateral financial institutions of which Nepal is a member, such as World Bank, Asian Development Bank and International Finance Corporation, as well as international rated banks. Additionally, if requested by the concerned bank or financial institution, the provision mentioned in the directive issued by this bank will be maintained and a zero risk weight may be applied for the purpose of calculating the capital ratio of loans provided by banks and financial institutions based on the unconditional guarantee issued by such international multilateral institutions. Now, credit loans and facilities provided by A-class licensed institutions to purchase and import the following goods to the following institutions with adequate arrangements to protect against credit-related risks. The institutions and items are Nepal Oil Corporation Limited, Gas and Petroleum Products, Nepal Food Corporation, Food Grains, Agriculture Inputs Company Limited, Agricultural Chemical Fertilizer, and Sole Trading Corporation, Agricultural Chemical Fertilizer. For these also, single obligor limit shall not apply. Now, next provision is number 6. Provision for providing loans and facilities under the guarantee and counter guarantee of joint investment banks and financial institutions. There will be no obstacle to providing loans and facilities under the guarantee and counter guarantee of joint investment banks and financial institutions operating under joint investment. However, the single obligor limit provision will apply to such loans if such joint investment banks and financial institutions are internationally rated banks. The provisions mentioned in point number 5A above will apply. So basically, single obligor limit provision will be applied to such loans, but if they are internationally rated banks, provision number 5A, which is mentioned above, will be applied for them. Now next is provision number 7, provision of considering clients with mutual relationships as one group. For the purpose of loan borrowing and facility limits, a group of customers with mutual relationship will be considered as a single group under the following circumstances. The very first circumstance is when a company acquires 25% or more of another company's shares, both companies are considered as such. Any individual, company director, shareholder in a private limited company, partner in a partnership firm, proprietor of a firm, and the spouse, son, adopted daughter, father, mother, stepmother, and the brothers and sisters whom they are responsible to support, whether living together or separated, are included. Similarly, companies in which the individuals mentioned in section B hold 25% or more shares, either alone or jointly. Companies in which the individuals mentioned in section B holds less than 25% shares, either alone or jointly, but control the management of the company in the following ways. By being the chairman of the board of directors, by being the chief executive officer of the company, or by appointing more than 25% of the directors of the company. Next is forms, companies, or members belonging to the same group. If a loan has been extended to more than one person under a single collateral, those individuals. Also, if a customer or company has guaranteed another customer company as per section B, then those customers are companies. However, in the case of hydropower projects with national priority, terms can be said to provide exceptions so that customers with a guarantee do not fall into the group of mutually related customers merely on the basis of providing a guarantee. If such a project is not completed within the stipulated time, such an exemption will not be or will be automatically revoked. Will be automatically revoked. In the case of entities other than firms and companies, individuals directly involved in the operation, control, or management of such entities, or their spouses, sons, daughters, adopted daughters, father, mother, stepmother, and brothers or sisters whom they are responsible for supporting, whether residing together or separately. Next is details of interrelated customers to be furnished. A record of a customer or customers with mutual relationships must be prepared semi-annually and sent to this banking and financial institution regulation department and the relevant supervision department within 1 month. This bank means Nepal Rashtra Bank. Next, number 9, provisions for considering as a separate group. An organized institution or company that is fully or more than 50% owned by the government of Nepal will be considered as a separate group. Number 10, provision for reducing concentration risks or minimization of concentration risks. If loans or facilities exceeding the specified single obligor limit are provided to any one customer, firm, company, or group of interrelated customers, it will be deemed a violation of this directive. In order to address the concentration risks that may arise from such a situation, 100% additional loan loss provision must be maintained for the amount exceeding the limit. Number 11, submission of large borrowers' credit details. Banks and financial institutions licensed by this bank are required to prepare and submit in the prescribed format the credit details of large borrowers. Those utilizing credit of more than 5 crore for class A and more than 2 crore for class B and C in aggregate form. This must be done on a quarterly basis within 7 days from the end of the quarter through the bank's reporting portal. The submission should include customer details, details of the large borrowers group, fund-based and non-fund-based credit details. Each customer must be classified under the relevant group when submitting these details. Number 12, provisions regarding sectoral loans. To control risks, licensed institution must establish adequate internal policies to monitor sectoral credit concentration. However, if directed by the bank, additional provisions for credit loss must be made accordingly. The list of various sectors of the economy is mentioned in Directive number 3.1 attached. Licensed institutions must categorize and monitor loans and facilities disbursed sector wise according to credit concentration in the following two levels and establish a control and information system as per the format in Directive number 9.3. So there are two levels. The level 1 is loans, advances and facilities disbursed in a single sector ranging from 50 to 100% of core capital. Such loans must be measured and monitored by the licensed institution's own procedure and information system and should be monitored at least on a quarterly basis. The level 2, for loans and advances and facilities disbursed in a single sector exceeding 100% of core capital, such loans must be approved by the Board of Directors of the licensed institution. The Board of Directors must decide annually whether to maintain or not maintain such loans at more than 100% of core capital. Licensed banks and financial institutions, except those permitted to lend only in single economic sector, are allowed to lend up to a maximum of 40% of their total outstanding loans in any one sector. Previously designated areas with limits less than 40% will remain unchanged. If the sectoral loan limit is exceeded, the excess amount must be deducted from the primary capital by the licensed institution. Now there are provisions relating to housing, land and real estate loans. They are the loan to value ratio for real estate loans and their collateral securities should be maintained at a maximum of 50%. However, for private residential home loans and home construction loans provided to registered and operational home construction companies or projects approved by the Government of Nepal, this ratio may be maintained at a maximum of 60%. Similarly, for first-time home buyers, a loan to value ratio of up to 70% can be maintained on a residential home loan of up to Nepalese rupees 2 crore, subject to the following conditions. The conditions are: the borrower must have a house or apartment of up to 3000 square feet solely for personal use. Also, it must be confirmed that no loan for house construction or purchase has been previously taken from any other bank or financial institution. When providing a loan under this facility, rental income cannot be shown as a source of the borrower's income. If the interest rate on the loan increases, arrangements must be made so that the predetermined monthly installment does not increase. Next is for the reconstruction of residential houses damaged by the earthquake of Kartik 2080, the ratio between the loan and its collateral security for the residential housing loan provided to families listed as earthquake affected by the Government of Nepal or designated bodies will require an addition of at least 10 percentage point to the ratio between the housing or house loan and its collateral security mentioned in subsection A and B. This ratio can be maintained up to a maximum of 100%. Residential home loans, commercial building and residential apartment construction loans, loans for commercial complexes that have been completed construction and begun generating income, and other real estate loans including land purchase and plotting loans have a loan limit set not to exceed 25% of the total loans. Additionally, the loan limit for other real estate loans including land purchase and plotting loans is maintained at 10% of the total loans. Concerning housing and real estate loans, the following must be adhered to. Real estate loan lending refers to the section number 6 explanation of real estate loans mentioned in directive number 9.3 for the purpose of outlined in directive number 9. Licensed institutions will not be allowed to restructure or renew loans on the aforementioned purpose or products that exceed the specified limits during loan disbursement. But in the process of maintaining overall limits, this arrangement does not compel any specific loan to be called back for repayment before its due date. Licensed institutions can collect the loan according to the installments maintained for each loan until the scheduled payment date. If the loan limit maintained under this arrangement is exceeded, a risk weight of 150% must be applied to the amount that exceeds when calculating the total risk weighted assets. In the case where a single bank provides loans for multi-unit residential houses and the loan is under the lead bank within co-financing, the amount deposited by apartment buyers for down payment or booking must be mandatorily deposited with the concerned or lead bank. Another, regulations regarding personal residential home loans. When calculating the limits according to subclause 4C, an individual residential home loan of up to or less than Nepalese rupees 20 million should not be included. An individual residential income or an individual residential home loan refers to a home loan provided by a bank or financial institution for the purpose of constructing a house or purchasing a house or apartment intended to be used by the customer themselves or rented out and determined with installments that the customer's income source can sufficiently support. So, before disbursing such individual residential home loans as per this clause, the bank or financial institution must prepare a proposal and obtain approval from the board of directors of the concerned institution. Such individual residential home loans as per this clause can be provided to a family up to only one from a single bank or financial institution. Now, there are regulations related to house or building construction. When disbursing loans for the protection of house or buildings within the municipality area or for their construction, arrangements must be made to verify whether the construction standards issued by the concerned local authority or office have been met. This includes obtaining documents such as the approval of the map, necessary permissions from other agencies, and certificate of completion or verification or recording of the house or building construction. When providing loans for house or building construction, loans should only be disbursed for buildings constructed in accordance with the National Building Code in metropolitan, sub-metropolitan and municipal areas and village municipalities where the Nepal government has implemented the National Building Code by publishing a notice in the Nepal Gazette. There are also regulations for loans on private vehicles. Licensed institutions, when providing loans for the purchase of vehicles for personal use, should finance a maximum of 50% of the vehicle's price, and in the case of personal electric vehicles, up to 80%.